Hello, my friends, and welcome to the March FOMC debrief. For those of you who don't know me, my name is Joseph. I used to be a trader on the Fed's trading desk, and now I teach and write about the markets at fedguy.com. So the March presser just finished, and I'm here to break it down to you as to what just happened. Now, before we get there, let's take a step back and think what happened since the last meeting. At the last meeting in January, Chair Powell guided the markets that he's going to do 25 basis points in rate hikes this time, and maybe a few more depending on how the economic data comes in. And then we got some pretty hot inflation data, pretty hot employment data, and pretty hot consumer spending data. The data seemed to suggest that inflation was actually not under control. And so Chair Powell, during his testimony at Congress, strongly suggested that, hey, the data seems a bit hot. In March, I'm thinking of going 50 basis points. And that was the assumption until 2 weeks ago. 2 weeks ago, as you guys know, we had a lot of excitement in the banking sector, not just in the regional banks here, but we also had something that was actually much more concerning, the failure of a GSIB, Credit Suisse, over the weekend. And I've already made videos about both those things, so I'm not going to get into that there. But that seemed to have changed the calculus of the Fed. So that brings us to today. Heading into today, the market was thinking, yeah, the Fed was going to hike 25 basis points, and then later on in the year, it's going to start cutting. So now, as the press conference is finished, we kind of know what happened. First, the Fed raised by 25 basis points. And second, they changed their language to suggest that maybe, we're very, very close to the end of the rate hiking cycle, but that doesn't mean we're going to cut. We want to stay around where we are, about 5%, and hold that for the rest of the year. Now, part of what I do here is to teach about how to interpret the Fed. So that's what I'm going to walk through with you right now. So the Fed speaks with the markets through the press conference, but also through its statements and projections. So you got to be very, very careful of what they write. Every word in these statements is by design. So there's a lot of thought that goes into it. Now, let me bring up first the statement that they gave in January. In January, this key sentence that I highlight is that the committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. That's the Fed in January telling you that we're going to continue to hike rates. Now let's look at the statement that they just released today, and you'll understand what they're trying to do. So instead of that sentence from last time, they have replaced it with this sentence. The committee anticipates that some additional policy firming may be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. So they've clearly backed down from ongoing rate hikes, signaling that it's possible that today may be the last rate hike. Although, as we'll see shortly, that's not apparently their base case projection. Now, every quarter, the Fed communicates its economic projections to the market through what's conventionally known as the dot plot. Now, the dot plot is basically a survey of all the members on the FOMC as to where they think that growth, inflation, and the Fed funds rate will be in the coming years. So everyone pays a whole lot of attention to the dot plot because that's a way that the Fed communicates what they're going to do. So the dot plot, which I'm pulling up here, is going to tell you, basically two things. So it's very convenient that they will project this March dot plot, the most recent one, against the December projection, which was the most recent dot plot before March. So what you want to focus on here is that, first of all, for 2023, they're not projecting any rate cuts. So the median projection for the dot plots is the same as in December. Basically, nothing's changed. They still think they need to hold rates around 5% for an extended period of time. The second thing that you should note is that the dot plot for 2024 went up a little bit from 4.1% to 4.3%. And that's a reflection of what appears to be more resilient inflation. So in this dot plot, the message that you want to take away is that the Fed still thinks that they're going to go higher for longer. They're going to hike to about maybe 5%, or maybe one more 25 basis point hike and hold here for the rest of the year. This is very, very different from what the market is pricing in. So right now, the market is pricing in rate cuts later in the year. Now, to be clear, the market has been very wrong this entire cycle. This entire cycle, the market has repeatedly been pricing in rate cuts just a few months away, even though the Fed has been resolute in saying that they want to stay higher for longer. There's a very good chart around that can show you that the market has actually a really terrible track record of predicting the Fed. But it is really important to know what the market thinks, because that's actually how monetary policy impacts the real economy. Whatever the market prices in is actually what the borrowing costs that people face. So if the market is thinking that rate cuts are imminent, well, people are going to have lower borrowing costs. So that's where we get to the statement. Now let's talk about what happened during the press conference. Now the press conference, in my mind, what stood out was two things. The first is that Chair Powell is aware of we have some kind of problem with the regional banks. It doesn't appear to be systemic. It seems to be that there is some problem localized among some banks that were poorly managed, which if you follow me, you know that I also share, and I have made videos and blogged about it. Now, what I thought was interesting was he basically strongly suggested that all deposits in the US are guaranteed. Now, for those of you who are not familiar with the US, in the US, deposits in a bank are guaranteed up to $250,000. In order to change that, you need an act of Congress. It's not something the Fed, the Treasury, or the FDIC can do themselves. But as we've also seen, when Silicon Valley Bank failed, the executive branch, so the Fed, the Treasury, and the FDIC, basically guaranteed all the deposits. And Chair Powell strongly hinted that all deposits will be saved. So what he's trying to do is he's trying to tell you that if another bank fails, he's going to do the same treatment he gave Silicon Valley Bank. He's going to guarantee all those depositors. Now, he can't go out and change the law himself, but once a bank fails, there are some certain special regulatory powers the FDIC, the Treasury, and the Fed have that can make depositors whole, just like they did in Silicon Valley Bank. He's trying to instill confidence in bank depositors so they won't run anymore. And he's also suggested that from what he sees, that the deposit outflows in the regional banks have slowed down. So the banking panic in the regional banks looks like it's getting better, and I believe him. So there's a lot of data out there that seems to show that the regional banks have had some outflows, but they've also shored up their liquidity significantly. So they're going to be able to meet those outflows. Now, that's part of the banking crisis. Now, the second part that he's talked about that is most interesting to me and most relevant to monetary policy is why that he's thinking that we should get to about 5%, maybe a little bit more, and pause. Remember, heading into the meeting, Chair Powell was suggesting that rates need to go higher because inflation seems to be more resilient. His rationale was that this panic in the regional banks is probably going to have a big impact, well, not necessarily big, some impact on bank credit creation. So in effect, it tightens financial conditions. It's kind of similar to another rate hike or two. It's really hard to see how big the effect is, but in effect, it's going to slow the economy down, and that has an impact on slowing inflation. Now, let me explain this a little bit. So monetary policy acts in many different ways, but one of the ways that it acts is through the bank credit creation channel. So banks create money out of thin air. And when banks create a lot of credit, create a lot of money, people have more money to go and buy goods and services, and that is stimulative for economic growth and for inflation. So one of the things that monetary policy tries to do is to reduce the rate of bank credit creation. Traditionally, they try to do this by raising interest rates. So if interest rates are high, for example, maybe you as a borrower don't go and borrow from a bank because the interest rates are too high, and so you don't have as much money to spend because you're not borrowing as much. Now, that's a traditional way monetary policy works, and that's kind of what the Fed is trying to do. But a bank can stop creating loans, not necessarily because the rates are too high and borrowers don't want to borrow, but a bank can also reduce how many loans it creates because it's afraid of a bank run. It's afraid that it might not have enough liquidity. And that's certainly happening in some regional banks. Some regional banks are going to be worried that whatever happened to Silicon Valley Bank might happen to them. They might have a lot of people who pull their money out. And if you're in that kind of situation, obviously you're going to cut back on your credit creation. So you're going to cut back on making loans, and that has an impact on slowing the economy. The Fed is not really sure how big an impact that has, but it has some impact. And so you can kind of say, well, I could hike rates to slow the economy down, but then the economy is also, through this credit creation channel, is also slowing because we have a little bit of a problem with the regional banks. So I don't have to hike as much. So that makes perfect sense to me. Now, what's really hard to know, though, is just how big an impact that this banking panic would do to the regional banks. Now, here's this chart here of loans and leases created by all commercial banks. And as we can see, and I've written about this as well, we had a tremendous surge in credit creation in 2022. Banks were, people were buying from banks. Maybe they felt very comfortable with their jobs, with their future earnings. Maybe interest rates were attractive to them. Anyway, the banks made a whole bunch of loans, and that contributed to strong growth in inflation. It's actually been slowing down pretty much a lot the first quarter. And as we see the data coming in the future, it may slow down a lot more because of this panic here. So that makes a lot of sense to me, and it definitely warrants a wait-and-see attitude. Now, the problem with this, of course, is that in the US at least, if you want to borrow money, you can go to a bank, but you can also go to the capital markets. The US is very different from other countries in that a lot of borrowing is done through the capital markets. Now, let me explain. So if you are someone who wants to buy a house, you can get a mortgage. You can get a mortgage from a bank, but actually half the mortgages don't come from a commercial bank. They come from an investor. So what ultimately happens is that a loan is made and then packaged into a security and then sold to a big investor. And an investor is not really impacted by any tightening in banking conditions. An investor is really looking at a spread to US Treasuries. So when you have the 10-year coming down a lot, so the 10-year today, there's kind of a big decline in the 10-year of 16 basis points, about 3.44% now. When you have a decline in the 10-year, because there are people in the markets that are thinking that the Fed is going to start cutting later in the year, that means that eventually mortgage rates are going to come down as well. Now, this is a channel that is independent from the banking sector. It's because the money lent through the capital markets is by investors who benchmark themselves according to US Treasuries rather than benchmark the investments that they want to make according to US Treasuries rather than the lending conditions of commercial banks. So as mortgage rates come down, as the 10-year declines, mortgage rates will also drop, and that could potentially reaccelerate housing activity and inflation. And not just that, if you're a company, a big company that funds itself in the corporate bond market, as the 10-year declines, you will also see your borrowing costs decline as well. So perhaps that would reignite investment and reignite spending, and you could see inflation reaccelerate again. So I think that's the big challenge going forward. Now, the Fed is going to be very nimble, and if we see inflation continue to stay persistent, if we see that the regional bank problem really is just a very localized bank problem, and that other banks in the US, so banks, let's say in Texas, Oklahoma, or the big banks in New York, are not impacted by this, then I think we can see rate hikes come back on the table again. So what I think is, in my personal view, what I think when I look at the markets right now is I think it's very unlikely that the Fed will be cutting rates later in the year, simply because there's so much underlying momentum in the US economy. Notwithstanding what happened with Silicon Valley Bank, you still have a very strong labor market, and you still have GDP growth that is, basically fine. So we'll see how this plays out. Now, the market today, strange reaction. So right then, when they saw the statement, after the press conference, we saw the risk markets rally. The S&P up a lot, Nasdaq now up a lot, and now they closed. Looks like it closed down 1 or 2%, 1.6%. When you look at the bond market again, bond yields declined a lot. That's consistent with the expectation that the rate hiking cycle was over, and consistent with that, we also saw the U.S. dollar sell off a lot. So all in all, it seems like a bit fuzzy price action. You'd think that the equity market would be happy that the bond market seems convinced that the rate hiking cycle is over, since usually equities like lower rates. I think there's a lot of fog right now. Now, I suspect that the bond market might be wrong again, as it was earlier in the year. If you remember, earlier in the year, the bond market was fairly convinced that the Fed would be cutting rates later in the year. We got some hot data in January, and then they changed their mind. So it's going to be very data dependent going forward. And that's all I have for now. I hope this was helpful. If you're interested in learning more about the markets, you can check out my site, fedguide.com. I also have online courses. I have a new course called Markets 101 that teaches you how to interpret macro markets. The first course is free. You can just sign up and click on free preview. And I'll meet you guys back here on Sunday. We go through our markets weekly. Thanks so much, and talk to you guys soon.